This is October, and today we are going to review all the stocks in my portfolio and to see what is their investment thesis. I'm ready for the club for mine, and today we are going to review every single stock that I have and that I plan to keep in the next 3 years in my portfolio. And we're going to review as well what's the investment thesis behind each of every single stock that I have in this portfolio. So let's get started. So first, let's have a quick look at the portfolio and what are the big themes that we are seeing today in the market. So as you can see in this portfolio, the first theme that we have is basically China. And we actually are betting that China is going to continue to grow. It's going to benefit a lot from the stimulus and that the economy in China is going to recover. The second theme that we are also having in this portfolio is obviously AI. So with Google, Amazon, and Brookfield. So we are actually betting on the fact that AI is going to bring a lot of efficiencies and that these companies are going to benefit tremendously, not just by the build out of AI infrastructure, but basically by the use of efficient AI. And that's why we have actually chosen specifically Google and Amazon, because they are going to benefit tremendously by improving their own basically businesses. And the third theme at the moment behind the investment thesis in this portfolio, as you can see, is basically the recovery of healthcare stock, because with managed healthcare, with Elevance Health and UNH, and with Novo Nordisk for pharma, basically like this healthcare industry or this healthcare sector has been beaten down, and we actually bet that this is going to recover in the next few years. So as you can see, like we have core themes driving this portfolio, and now we are going to review each of the single holdings in the portfolio one by one and understand why we are having them in the portfolio. So the first and the biggest holdings in this portfolio is, as you can see, Alibaba. So why Alibaba? Actually, we have been holding Alibaba for quite a while now, and we have recognized quite early the fantastic opportunity that we had in China, and more specifically in Alibaba. We have done other videos explaining before the rise how Alibaba was going to become an AI leader in China, but also globally. And actually the market actually caught up to this thesis. And today, this is the biggest holding in the portfolio. We have been able to trim a little bit to actually reinvest in other opportunities, but definitely this is going to stay the biggest holding in the portfolio because this is where we are seeing the biggest opportunity. Not only we have the Chinese basically tailwind, but we also have the AI tailwind for Alibaba. And I think that Alibaba is going to continue to power the AI revolution in China, and the business of Alibaba is going to benefit tremendously from that. So we have seen in the past basically few weeks, I would say, like a catch up in terms of valuation. So basically Alibaba was very, very undervalued. Today it has become a little bit more fairly valued, especially compared to JD.com. But definitely like what we have seen today, just a catch up in terms of valuation, and we are going to see actually going forward the growth of Alibaba reaccelerating, especially in terms of cloud. And this is how we are going to continue to benefit from basically the Chinese story with Alibaba. Then the second biggest holding in this portfolio is, as you have been able to see, it is PayPal. So why are we so heavy on PayPal? Just because the numbers are too good to be true. They are, and PayPal is basically too cheap to ignore, and we have to take a big bet on PayPal because mathematically PayPal is going to become much higher in the coming years. So the growth is here, especially in terms of earnings. So PayPal is growing and is growing profitably. So we are going to see double-digit growth in terms of EPS, especially on the back of huge buybacks. So the buyback yield today is above 7% basically for PayPal. And so what we are seeing is that despite the depressed valuation, despite the bad negative and the bad narrative for PayPal, what we are seeing definitely is that PayPal has a lot of opportunities going forward to grow and is going to surprise a lot of people. And I think that today at $68 per share, this is actually quite a huge opportunity, and we have to bet big when we are seeing this type of opportunities. So definitely PayPal has the potential to double or even triple in the coming 5 years, and this is something that we should not miss. And that's why actually like PayPal is going to be one of the best performing stock in this portfolio, given that everything is aligning perfectly to have a very good setup for PayPal. But the stock has been dead actually in the past few years, so maybe a lot of people are actually adopting that. But there will be a time where the buybacks will actually start working very well in terms of providing the growth, because as time passes, the effect of buyback is going to actually come to fruition, and we are going to continue to see the growth in terms of EPS, the growth in terms of cash flow per share. And this is going at some point when the narrative changes, very similar to Alibaba. When the narrative is going to change, this will be an explosive growth in terms of share price. And people are going to be surprised. But the reality is that PayPal is so undervalued today that when people realize that growth in terms of revenue and in terms of earnings is going to reaccelerate significantly, especially from the different opportunities that they have in ads, stablecoin, or agentic AI, like a lot of big funds are going to come back to PayPal and we are going to see huge growth in terms of share price. Then the third biggest holding in this portfolio is Google. We have done also a lot of videos about Google when it was at $150 or $160 per share. Today it's at $250 per share, so much higher. And basically, like the thesis that we had at the time is actually or has actually played out very well and is going to continue to play out in the coming years. So the thesis is basically very simple as usual. The thesis is that Google is the AI leader in the market, and we have seen that. Why? Because they have the full stack in terms of AI. They have the data, they have the hardware, they have the models, and they have the products. And so they are continuing to execute on this. And what we are seeing is that they are continuing to become and they are continuing to actually be the leader in terms of AI today in this AI race. And I think that they're going to profit the most in all these different players going forward with Google Cloud, with Gemini, with DeepMind, and they're going to actually get a lot of profit, especially as Google search actually limit the downside or limit the decrease coming from a lot of different competition. So well, we are going to follow the Google story, definitely. And that's why today is still the third holdings in this portfolio. So the fourth biggest holding in this portfolio is today Amazon. So why Amazon, even though it has not actually performed very well lately? So because it has a lot of potential, especially in terms of margin improvement. So with AI, so what we are going to see for Amazon is that we are going to see a lot of margin improvement. And given that they have one of the biggest revenues in the market, so what we expect is that it's going to surprise a lot of people how with physical AI, so basically robotics, they're going to be able to improve their e-commerce business and their logistics business. And on top of that, so with AWS, they are going to benefit tremendously from the rise of Anthropic and Cloud Code. So I think a lot of people are kind of sleeping on Amazon today, especially on the AWS side, because they haven't posted the biggest number in terms of growth compared to Google or compared to Microsoft. But if we look at what Microsoft did with OpenAI, Amazon is doing the exact same thing with Cloud and with Anthropic, basically. And so given the rise of popularity of Anthropic and Cloud very lately, so I wouldn't be surprised if they report like explosive growth in their next quarter. And when this happens, like, we are going to see the stock price move very quickly to the upside. That's why we are keeping like Amazon today, and I think that it's going to be a core holdings because it's a long-term hold. Amazon, like they are executing year after year, and I think that even though that they're not performing very well in terms of stock price in the past few years, they are always a very good holding to have in your portfolio because they are performing very consistently on a year-on-year basis in terms of business, and I think that they are going to continue to grow for the very long term. So definitely Amazon, I think, is a core holdings and a core position that everybody, I think, should have in their portfolio. So next we have another company which is very similar to Amazon, but in this time in China, and this is JD.com. So why we have such a position with JD? The first reason is that because JD.com is very cheap. So if you look at the price to operating cash flow today, around 5, and if you look at the price to free cash flow, for example, around 10. So basically, definitely a very cheap stock with a good dividend around 3%, like buying back shares, and definitely is going to actually benefit from all the Chinese recovery in terms of economy. They are benefiting already from the Chinese stimulus. So I think that JD.com has everything to basically double in the next 2 or 3 years, given the undervaluation. But they have not like run like Alibaba or Baidu very lately in China. But I think that as the Chinese bull market continues, I think that JD.com is going to benefit tremendously and is going to be one of the best performers in China in the coming years. So that's why I think that JD.com is actually a very good position today in the portfolio. In terms of stock price, sorry, well, it was a better buy a few weeks ago, below $100 Hong Kong dollars. But I think that it's still a good position. I wouldn't chase too much if it rises in the coming weeks, but I think it's a very good position to have in your portfolio as well. The next position in the portfolio is UNH, so United Health Group. And we have done also videos on United Health Group and what is investment thesis. So basically, so a lot of health insurers in the past few years have actually underpriced their plans, and they have been hit by a lot of medical utilization of the different plans. So that's why they had a lot of higher medical loss ratio than what is usual. But the opportunity in UNH, and we will say as well in Elevance Health, is that all these health insurers, they are going to reprice all the different plans. And what we're going to see is that a reacceleration in terms of earning growth, a reacceleration in terms of revenue coming from this repricing. And so for United Health, so we had this repricing, we had the evaluation expansion because United Health was actually very cheap, especially at $250. To be very transparent, it's actually a little bit less cheap today at $350. But still, the story about the repricing and the improvement of the business, because United Health is one of the biggest health insurers in the US, and I think one of the best business in this industry. And so I think that this is going to recover, especially in terms of earnings, and we're going to see as well a repricing of the stock price. So the target today is around $400 or $450 for us in the next 2 years. Next in the portfolio, we have Novo Nordisk. Why Novo Nordisk? Because today it's actually quite cheap and it has been beaten by the market with all the bad news that we have seen very recently around Novo Nordisk. But still, I think this is one of the leaders in the diabetes and obesity drugs in the market. And I think that they're going to be able to actually have a pretty huge turnaround, especially if they are able to actually come to the market first with the oral GLP-1. And I think that this is going to be a real hit for them. And despite actually the Trump tariff and all the bad news that we are seeing for Novo Nordisk, I think they still have a huge opportunity with this big market in terms of obesity and diabetes, where they are one of the key players with Eli Lilly. And so definitely today, like, they are undervalued. And so what we are seeing is that today they're almost undervalued by like 30%. So what we are hoping is to have like a valuation expansion by 50% to come back to their average valuation. And on top of that, to have a growth of 30% in the earnings in the next 3 years. So with this, the target in the next 3 years for Novo Nordisk in our portfolio is around a 2x. And given that given the size of the market for Novo Nordisk and their ability to come up with new drugs basically in their pipelines, so we are going to see come back to growth. And given the size of the market of the obesity and diabetes market, so we see a lot of opportunity for Novo Nordisk today to continue to grow and to benefit from valuation expansion. It's definitely a good buy today in our portfolio, and you can refer to the video that we have done on them previously. Next on the list is Elevance Health. So Elevance Health has the exact same thesis as UNH, basically, that they have been hit in terms of profitability with unexpected higher usage or utilization rate of their different plans, and that they are going to reprice in 2026 all the different plans. And what we're going to see is that basically a growth in terms of revenue, but especially a growth or reacceleration of growth in terms of earnings coming forward and improvement of the margin coming from this repricing. And why Elevance Health and not just UNH is because Elevance Health is much cheaper and much cheaper than UNH has ever been. Basically today, we have done a video especially on that as well. And so today, I think that Elevance Health is even a better opportunity than UNH, and is going to benefit even more from the repricing as UNH. So definitely a very good opportunity for us today. Then the last stock in this portfolio, or the last holding that we have, is Brookfield Corporation. Today it's a bit undersized, to be honest, compared to the potential of Brookfield Corporation and what they have showed us in their latest Investor Day 2025, meaning that they are planning to actually double basically their earnings and their planned value in the next 5 years. So today, what we are seeing in Brookfield is actually a lot of tailwinds coming from AI, tailwinds coming from retirement needs, tailwinds coming from expansion of the monetary mass and the need for alternative investments and private investments, especially for a lot of different retirees. And I think that especially also with the real estate recovery, I think that Brookfield Corporation has a lot of opportunities going forward in the next 5 years. And I think that they are going to be able to execute on their plan, and they are going to grow at least more than 2x their earnings. And we can definitely expect that the stock price as well is going to grow by 2x in the same way. So that's why I think that Brookfield Corporation today is a fantastic opportunity. If there is no like Great Depression, I think that there is a lot of possibility for Brookfield Corporation to continue to expand their business and to continue to expand also the stock price. So that's why it's in the portfolio. And maybe so if we see any retracement or if we need any opportunity to add to Brookfield Corporation, we should be able to do that. But today, that's the last holdings in the portfolio. And if you're interested in other analysis about all these different stocks, and maybe also tell me like what you think about this portfolio and the different stock in the comments. So please check my other videos, please subscribe, and I'll see you in another one. Bye.